Everyone knows someone who regrets not buying property. Almost nobody talks about the people who regret buying it. Not because they don't exist, because admitting it feels like admitting failure. Picture this. A young couple finally gets the email they've been waiting for. Congratulations, your loan has been approved. There are tears, phone calls to family, celebration dinners, Instagram photos holding oversized cardboard keys. For a moment, it feels like they've crossed an invisible finish line. They've made it, but 12 months later, they're earning more money than ever before. Yet, somehow, they're living paycheck to paycheck. They own a home, but they can't afford a holiday. They delay replacing their old car. Every unexpected bill feels like a small financial emergency. So here's a question no one seems willing to ask. How can someone own an asset worth hundreds of thousands or even millions of dollars and still feel broke? The answer has almost nothing to do with property prices. It has everything to do with the story Australians have been telling themselves for generations. For decades, buying a home hasn't just been a financial decision. It's been treated as a milestone. Finish school, get a job, find a partner, buy a house. Somewhere along the way, home ownership stopped being one possible path and became the definition of financial success itself. Renting, meanwhile, became something people were expected to escape. You'll hear it at a family barbecues, from workmates over lunch, even scrolling through social media. You're just paying someone else's mortgage. It sounds logical. It feels obvious, which is probably why so few people ever stop to ask a much more uncomfortable question. If renting is throwing away money, where exactly does a homeowner's money go? Imagine collecting the keys to your first place in Melbourne's outer suburbs. The first mortgage repayments leaves your account. It feels satisfying. You're finally starting to build wealth. Or so you think. Weeks later, you open your loan statement. Most of that money didn't reduce your debt. It never became your equity. It simply disappeared. Not because you were scammed, because that's how mortgages work. In the early years of a typical long-term home loan, a large share of each repayment goes towards interest rather than reducing the amount you owe. You're not paying yourself. You're paying for access to borrowed money. And once you notice that, something else starts to stand out. Interest isn't the only bill that ever comes back. Council rates continue arriving, insurance premiums continue rising, the hot water system eventually fails, a leaking roof can't wait until next payday, the fence falls over after a storm, termites don't care about your mortgage. Owning a home means becoming responsible for every problem attached to it. Eventually, each expense seems manageable. Together, they quietly become something far more significant. Financial costs that disappear forever. Costs that build little or no additional ownership. In other words, money that's just unrecoverable as rent. That doesn't mean buying is bad. It simply means that the comparison Australians usually make is incomplete because we're comparing all of rent against only part of ownership. Once you include mortgage interest, maintenance, insurance, rates, and the cost of buying and selling, the gap begins to look very different. And that's where another question appears. If ownership carries all these hidden costs, how do you know which option actually makes financial sense? Surprisingly, one of the simplest answers comes from a number most people have never heard of. It's called the price-to-rent ratio. Instead of asking whether property prices are going up, it asks whether buying today's property is financially efficient compared with simply renting the same lifestyle. Imagine a home selling for around $1 million. Now, compare that with an equivalent home rents for over an entire year. If purchasing that property costs dramatically more than renting it, the numbers begin sending a very different message from the one emotions usually tell us. In some expensive Australian markets, the purchase prices climb so much faster than rents that buying becomes increasingly difficult to justify purely on financial grounds, which creates a strange possibility. The renter may actually be accessing the exact same lifestyle for far less money. They live in the same street, drive past the same cafes, use the same schools, enjoy the same parks. But someone else carries a financial risk. If the air conditioner dies, it's not their bill. If structural repairs appear, it's not their savings disappearing. If the property market stalls, They haven't concentrated most of their wealth into a single address, and that leads to perhaps the biggest hidden cost of all, the one that's almost invisible. To buy a home, many Australians spend years saving a deposit, sometimes well into six figures. The day settlement arrives, the money effectively changes jobs. Instead of remaining flexible capital, it becomes locked inside bricks and concrete. It can't easily be accessed. It doesn't automatically produce income. It simply sits there as equity. Now, imagine another person. Instead of tying up the same amount immediately, they invest into a diversified portfolio while consistently investing the ongoing savings created if renting remains cheaper than owning. Over long periods, diversified investments have historically delivered strong returns, although future performance is never guaranteed. Suddenly, the conversation isn't simply about houses anymore, it's about opportunity costs. Every dollar committed to one investment is a dollar unavailable somewhere else. And that's exactly why two people earning identical incomes can finish decades apart financially. One concentrated almost everything into a single property. The other built wealth across multiple productive assets while remaining liquid. Neither approach guarantees success, but only one provides flexibility, which matters far more than people realize. Life changes, job change, relationship change, a better opportunity appears interstate, the renter packs a truck, the homeowner prepares contracts, agent commissions, advertising costs, settlement delays, and the possibility of selling into a weak market. Mobility isn't usually discussed as an investment. Perhaps it should be, because sometimes the ability to leave quickly becomes one of the most valuable financial assets. Of course, buying still has genuine advantages. A mortgage repayment can provide more certainty than rising rents. Many Australians value stability, personalization, and putting down long-term roots. For household planning to stay in one place for many years, those benefits can outweigh the additional costs. But that's very different from believing property is automatically the best investment you'll ever make. Because that's the myth. Not that buying is wrong, but that buying is always right. The real goal was never to own a house. It was to build financial security. Sometimes those two paths overlap. Sometimes they don't. And perhaps that's the most expensive misunderstanding of all. A home can absolutely become part of a wealthy life, but the deed itself was never the destination. The destination was always freedom. And confusing those two ideas has quietly cost Australians far more than most people ever realize. If you enjoy documentaries that challenge conventional money advice, consider subscribing. Thanks for watching. I'll see you in the next one.